How to calculate cash flow in real estate. It's not as complicated as most people make it out to be, but it is important to understand, especially if you want to escape the rat race and enjoy financial freedom for yourself. Yeah, you heard me right. Cash flow is that very thing that could escape you from the daily grind and create a life for yourself that's free of money worries. And I'll let you in on exactly how to calculate it. You ready? Let's go. So I'm going to show you how to calculate cash flow. I'm going to first give you the quick and dirty math version, then I'm going to give you the slow and detailed math version. Both have their place and are very important to understand. And if you'd like some help finding affordable cash flowing properties, if you wait till the end, I'll show you how to get that help to find them, so you can get to your financial freedom in one of the easiest and fastest ways. Cash flow. It's one of the 4 profit centers of real estate. But it's the one most people will focus on, particularly if escaping the rat race is their real estate goal. Because it's income, and that's what we need to survive. It's the income that's left over after all of the property's expenses and debt service have been paid for. It's the profit. The cash flow goal, in its simplest terms, is to invest in properties that are going to pay you more than it costs you to hold on to those properties, than it costs you to maintain them. So the quick and dirty math version to determine whether a property will cash flow or not is what we call the 1% rule. And what that rule says is your monthly revenue, the monthly rent from the property, needs to be at least 1% or greater of the purchase price of the property. And that purchase price includes the acquisition price and if there are any repairs or not. If the rent is at least 1% or greater, then those two numbers combined, the purchase price and the rehab price, the property is likely to cash flow. Not for sure, but likely to. When you find a property like that, now it is worth your time to go ahead and dive deeper into the numbers to determine whether it actually will cash flow. And I'll get to that in just a second. But the 1% rule, it looks like this. If I'm purchasing a property for $100,000, and let's say there's going to be $25,000 of rehab. What that means is my acquisition price or my purchase price is going to be $125,000. And so what I need in order for this property to cash flow, I need to be able to rent for at least 1% of this number, which would be $1,250 a month. That right there is 1% of my purchase price. And you can reverse it too. For example, if you know a property rents for $1,500 a month, you know now that you cannot afford to pay $150,000 or more for it. If you pay over $150,000 for this property, it's likely not to cash flow. So that's the quick and dirty math. And that's about as far as I will go with any real estate deal. And I won't go much further than that until I get the property actually under contract. Then I'll go ahead and do the detailed math to determine whether or not it will actually cash flow. Now, before I break down the slow and clean steps, the 5 steps to calculating cash flow the real way and getting the real number, if the wheels are starting to turn, you're getting some ideas, click the subscribe button. Let me know, because I post cool videos like this each and every week and you don't want to miss it. Click the subscribe button. Now, let's run through the 5 steps to calculating cash flow through rental property. In step 1, your gross monthly income. Basically, what does it rent for? And don't forget other revenue streams as well. Like maybe you're charging for an extra parking space, you're charging for storage, maybe you've got a laundry facility on site, or maybe you are renting them appliances, maybe you furnish the property, and maybe you are charging pet rent. All of that counts, so you need to add all of that up to get your gross monthly income. Now that you got that number, it's time to start deducting the expenses. So the second thing you want to do, step 2, is subtract the expenses. And that first expense that you want to factor in is what we call our vacancy rate. Vacancies can really thwart your cash flow expectations. It can ruin everything. Though no downtime in between tenants is ideal, you do want to anticipate that the property might be sitting vacant for a little while. Maybe it is just a few days or a month in between tenants, or maybe it's multiple months. And that's a realistic thing to consider depending on what type of market you're in. And this can be a really difficult thing to calculate. It's not an exact science. So a good starting point might be to check in with a property manager and see what type of turnover time that they have in between tenants and how long it's taking to get a new qualified tenant for properties. So that's right, you kind of have to guess. but you want to get as much of an educated guess as you possibly can. That's why if I don't know any better, if it's a brand new market for me, I will check in with a property manager to get their idea or their opinion. Now, if the market is hot, 2%, that's typically a good number to use. 2% of the gross monthly rent that you're collecting. But if your property were to sit vacant for just 1 month, that's an 8% number. And that can be significant because not only are you not receiving rent that month, you also have the expenses that you have to pay as well. So vacancies, they're no bueno. Now, there are a lot of recurring expenses that accompany a property as well, and they're gonna vary from property to property, but I'll give you a list of what you can expect. First, you've got property tax. There's no getting around that. Property tax, depending on what state you're in, that could be a biggie. And then there's insurance. You have to have your properties insured. And then you've got property management fees. If you're not gonna manage the property yourself, you definitely wanna factor that in. If you are, then you don't need to necessarily calculate this. And then there's HOA dues, if applicable. That's not gonna happen with every property, but some for sure. And then there's maintenance and repairs. Now this can be another area where you kind of have to make an educated guess. And for our properties, we typically calculate anywhere from 2 to 5%. That's 2 to 5% of the gross rent will actually go to maintenance and repairs. Now, step 3, you want to calculate your net operating income. And your net operating income is what you get as a result of taking your gross monthly income and subtracting all of your expenses. That gives you the net operating income. Now, to get to your actual true cash flow number, step 4 is to subtract the debt service. So to get to your true cash flow number, you're gonna take your gross monthly income, subtract your expenses, that gives you your NOI. Then you subtract your debt service, and that will give you your cash flow. So knowing this calculation and how to determine what your actual cash flow number is a really important number for you to make a wise investment decision. After all, the goal is to cash flow while the property appreciates in value. And if you're looking for properties that cash flow while they're appreciating in value, it might make sense for you to talk to Mercedes. So go and download her free investor package. You can get that at cashflowsavvy.com. And then after you download that, you'll be able to pick a time to hop on the phone with her and brainstorm some ideas as to what this might look like in your investment portfolio. How can you benefit from cash flow? How can you benefit from the appreciation of real estate? Go to cashflowsavvy.com. You can take that, type it in the browser, or I'll go ahead and I'll put the link down below in the description for you for your convenience. Cashflowsavvy.com. Thanks for watching. I'll see you next time. Take care.